coming out of the QOV, we understood, okay, if we invest in sales and marketing and we flesh out that muscle in the business, here is the incremental gross margin that we earn for every customer that we bring on. And through our initial commercial diligence, we were able to say, okay, this is a huge addressable market in North Carolina and nationally. It's a fragmented market too. So if we can be better on the sales side of things, if we can really invest in that, knowing that kind of what the customer acquisition cost to LTV would be, that is something that we as entrepreneurs can understand in the first 90 days what are going to be our highest priority items.
Search Party is sponsored by Avid Bank, Boulay, Mayor Brown, and Plexus Capital. The lead sponsor is Next Coast Legacy. Hello and welcome to Search Party. I'm David Snow, your host. And today we're joined by Bob Boniface of TransTech, Anthony Walker of Next Coast Legacy, Clay Brownlee and Ryan Turbes, both of Boulay. Gentlemen, welcome to Search Party today. Glad to have you here. Today we're talking all about the importance of due diligence in lower middle market companies. In particular, we're going to talk about quality of earnings, which is a form of due diligence that some people know about, but a lot of people don't. We have a very great case study that we're going to dive into in the form of Bob Boniface's acquisition of TransTech last year. Bob, you are an entrepreneur through acquisition, ETA. You set out to look for a high-quality, lower middle market business. You acquired it with partners, and now you're running it. So, Bob, why don't we just start with, you can set the stage. What kind of a company were you looking for? And when you came across TransTech, what did you like about it?
Yeah, great question. So I should preface with what TransTech does. TransTech is a commercial driver's license school. We have 9 branches around the state of North Carolina. When my partner Tyrell and I started our search, we were looking for a blue collar business. So it's a pretty big definition. There's a lot of companies that could fall into that. A lot of them aren't great candidates for a search fund because they don't meet a lot of the requirements for a great acquisition target. But when we were looking to buy our business, we talked about putting men in trucks. And what that really looks like was plumbing companies, HVAC companies, any kind of blue collar business that had fleets of people out doing services kind of on a business to business basis, potentially business to consumer, very predictable revenue, businesses that were critical to their customers, businesses that met a certain size. Of course, we were looking for a business that had about $2 million in EBITDA or more. And we wanted a type of company that we felt comfortable running because my background is in automotive. My business partner's background is in oil and gas engineering. So we didn't feel like we would be the best buyer of a company that would be in healthcare or software or anything that really didn't fit our background. We felt that we could relate well to employees and potential sellers or owners of these businesses that saw our background and felt like we might be a good fit for taking it to the next level.
Excellent. And we're going to get into the part where you actually dug into the financials of the company. But maybe Clay or Ryan, can you start by talking about what is quality of earnings? And you work with a lot of ETA searchers, many of whom are on the young side, have never acquired a business before. What do they need to know about quality of earnings?
A great question, David and Bob. I love how you planted the seed. Discussing your right to win is always a key element of your journey. So first, I'm just going to talk quickly on what is a quality of earnings, because I think there is some misconception in the marketplace. So quality of earnings, it's not an audit or a valuation engagement. It's a consulting engagement that combines audit type testing, so looking at source documents, as well as looking at some run rate, pro forma, non-recurring type expenditures or networking capital matters. And we're really focusing on building out that analyses on a monthly basis. Oftentimes the companies in this space are more focused on what cash is in my bank account and what's my tax reporting requirements. It's not a one size fits all. So what we are doing is actively working with individuals to customize those specific procedures based on their needs and the specific niche or industry, as well as what are the investors focusing in on and how do we mitigate those risks so we can ultimately try to kill the deal as fast as possible. We should not be delaying those difficult conversations with the potential seller, or we may discover a key finding that we would discuss with Bob to say, hey, EBITDA floor was $2 million. We're approaching 1.8 million. We probably should have that discussion with your investors so they understand that maybe that multiple isn't a 5 multiple of your business. It's now approaching a 6 or 7 multiple. And we need to get in front of your investors to make sure it's still an equitable deal.
I think I would add to that, although EBITDA and working capital are really key parts of the deal, there's oftentimes other metrics that are financial metrics that are very key to the thesis that are important things to validate during that QV process and continue to have those conversations with investors such as Anthony.
From the investor perspective, QV is a critical turning point in the deal process for us, as it is really the first opportunity for us to be able to assess the financial information that the sellers have provided and to verify that it is what they said it was, right? And we have to keep in mind that these are small businesses, and oftentimes they do not have a CFO. They may not even have a controller to assess whether or not they're doing well. Am I collecting more cash in January than I did in December, right? And oftentimes that is detached from the financial reality of the business, depending on when that product or service was rendered. And so the QV is a very good litmus test for us as an investor. Are we buying what we thought we were buying? If so, great. That's confirmatory and informs our ability to go look at other elements and other areas of the business from a commercial diligence standpoint to substantiate whether or not we still want to invest. But as a baseline, we've got to believe and know that the revenue and EBITDA as presented is accurate, and it informs whether or not, as was mentioned previously, we need to approach valuation differently and have a tough conversation. But you can't do that without the clarity and the visibility into the actual financial, which is what folks Boulay and others in the space provide for us that give us confidence to move forward with the transaction.
What are some common misperceptions among first-time ETA acquirers about quality of earnings? What do they think it's supposed to accomplish that might not be exactly what it is supposed to accomplish?
Yeah, I think the most common misconception is that it's a check the box exercise. It is not that. There is information provided within the process of going through the quality of earnings that is informative to how you run and manage the business going forward. Many of these businesses at acquisition are on a cash accounting system, right? They're not accruing when cash was received relative to when the product or service was delivered. And that has really important implications as you think about your working capital management strategy. And you think about, if you have an inventory heavy business, when you actually need to purchase inventory ahead of being able to provide that service. Those are elements that are uncovered through the course of the quality of earnings analysis. It's not just substantiating that the EBITDA of the business is what they said it was. There are also some fundamental kind of operational considerations that come from the analysis that is produced through that exercise.
Working capital cash conversion cycle is a key function of something that you can glean out of the QV process. And even beyond that, some of the narrative around understanding who's involved in that accounting and finance process, what may need to change post-close, it's getting you ready for those first 90 days post-close as well, and validating those assumptions that you've made to build your thesis and those conversations with investors. It's important to not just say, okay, EBITDA is checking out where we thought it was. We're going to come up with working capital, but understanding how that integrates into the deal and the negotiation itself.
Our business is very much now run on an accrual-based accounting process. It was cash-based when we were doing our quality of earnings. And so what does that look like? A student is prepaying for a class and enrolling in a class that will occur on a future date. TransTech has to provide the service, pay the instructors, pay to fuel the trucks, pay for all of the utilities, everything that goes into training these students. And the view that the seller had, because it was on a cash basis, was, did my bank account go up last month versus this month? That's really not very relevant, honestly, to running the business on a daily basis, on a monthly basis, or on a strategic planning basis, because you might sell a ton of students at the beginning of the year, and we typically do, because people are looking to make a change at the beginning of the year, and that's kind of who our customers are, people that are looking to improve their earning potential. And you might be falsely understood that, okay, this is something that's going to continue every single month. let me go out and hire a ton of instructors. Let me plan to have this big backlog of business that will continue through the entire year. Well, that's not always the case because we see something fall off. So you want to be able to plan around the ebbs and flows of the business, understanding that sometimes you're going to get the cash up front. We're going to still have to service this revenue in the future. There's going to be a cost associated with that. And in the deal process, in terms of the quality of earnings, getting the seller to understand that can be difficult sometimes because they're looking at the bank account saying, I did a great job last month. We're looking at the bank account and saying, okay, you're going to take all of that cash with you, and we're going to be stuck with servicing these students in the future without having the money to pay for the instructors. So it's kind of a delicate kind of balance in a business like this.
Bob, I'm glad you mentioned the seller. Before we get to your story, can I hear from the due diligence experts about what are some common misperceptions that the seller might have when it comes time to do quality of earnings?
Oftentimes for a seller, this is their first time going through this exercise. Bob and Tyrell and others are asking them for very intimate details about their business and their financial picture. Tax returns, access to QuickBooks, kind of full download of bank account statements, etc. And that can be quite jarring. And yes, they have agreed to sell their business. Yes, they understand that the acquirer needs access to full information. But until you've asked for it and they've gotten that kind of laundry list of requested documents, I think it can be a challenge for them to really come to terms with what that means and what the level of visibility is required to go through this process. But I also think that the output of the quality of earnings oftentimes puts the searchers or buyers in a little bit of an adversarial position with the sellers, because they come into the conversation with a perspective of what they are generating that may be ill-informed, and it may be on a cash basis, it may not be on an accrual basis. And what the quality of earnings provider is providing is an accurate view of the health and financials of that business. And those two things may not be aligned, and they may not be consistent. And Bob and Tyrell, I believe he ran into this, and we had a lot of conversations around kind of what the QEV said versus what the sellers were saying in terms of the ultimate EBITDA business. It is not intended to be an us versus them conversation. We all need to have an accurate perception and a realistic view of what the business's financials look like. But that is often not the perspective of the seller when we're having these discussions. And so from a searcher's perspective, I think you've got to be aware of that.
The biggest thing that we can tell on the front end is when we have a kickoff call, whether or not we're dealing with someone who has sophisticated counsel or advisors behind them, or if we truly have to roll up our sleeves, which is often the case, and educate them on what we're doing and why. So as Anthony alluded to, it's not us versus them. And this is where, with us being, primarily based in Minneapolis, Minnesota, I don't know if it's the Minnesota nice that comes through the entrepreneurial spirit of our firm, but we want to understand what the seller has been doing. And ultimately, wherever you are on that cash to accrual conversion, we're going to work towards GAAP or full accrual accounting, because that eliminates all games that can be played. And that is the most fair to all parties, specifically when we think about normalizing EBITDA and net working capital and consistently applying those revenue and cost recognition practices across a historical period. Sometimes when we think about the LOI, you're going to have asset or stock deal. And depending upon the entity type, the seller may or may not know what the eventual impacts of that deal structure are going to be to their net cash, which is ultimately what they care about. So an example of that could be if you have a specific niche manufacturer and they have a substantial amount of fixed assets, that depreciation recapture can be a key negotiation item later on in the process that, again, depending upon whether or not the seller has sophisticated counsel, they may not understand the tax ramifications of the value that's assigned to those fixed assets as part of the purchase price allocation.
Even though the LOI may include, we're going to acquire a normalized level of working capital, it's a little bit glossed over, and the seller either is really heightened on that and wants to know what is that number you're going to be asking for, or is just confused by the concept of working capital. What do you mean I have to leave you receivables, etc.? We lean in as much as needed throughout that process to really educate what are we doing, what is our role, that cash to accrual conversion, helping them understand that really we're not there to tell them what they've been doing is right or wrong. They've run a successful business. They have cash in the bank account. We are helping translate their financials from a cash to accrual basis, just helping clients like Bob understand what may need to change when they move to an accrual basis post-close.
Let's take a quick break to learn about a partner you should consider as you build a business in the lower middle market, Avid Bank. Based in Silicon Valley, Avid Bank has been dedicated to the search fund community for more than 10 years. The professionals at Avid Bank are seasoned veterans of the entrepreneurship through acquisition strategy. They have a long history of working with growing companies across the life cycle of an investment. With more than $2.25 billion in assets, Avid Bank is known for its highly responsive, consultative practice, as well as its deep knowledge of M&A financing in the lower middle market. The friendly professionals at Avid Bank have a straightforward motto: we do what we say. And they really do. Look for episodes of Search Party that feature market commentary from Avid Bank experts. You'll learn a lot about the dynamics of lending and finance in the lower middle market. All right, now back to the episode. Bob, let's get to your story. You were looking for a great company. You found TransTech. You liked it. You entered into due diligence, including quality of earnings. What did you discover during that process that had an impact on the negotiations and the way you thought about the business going forward?
I'll set the stage. We had found TransTech, and we'd also spent a significant amount of time learning about the industry. At this point, we had already built up, I think, a reservoir of goodwill with the sellers, which I think is a really key part of any type of transaction in the search fund space. You want to get to know them as people. You want to understand it. This is a business that you love, that this is a business in an industry that is going to be important in the future. Understanding that once you get the quality of earnings, it's a little bit more black and white, and you might have to encounter a negotiation if the numbers change from what you planned in your LOI. What we discovered in our QV, what I think is not atypical to a process like this, is the fact that revenue was lower. Revenue was lower, and in a business like this that has operating leverage, that means that EBITDA is almost on a one-for-one basis going to be lower, probably about 25% lower, which significantly changes the equation. So instead of, say, you're paying 7 times, you're now paying 9 or 10 times based on kind of the new EBITDA number. It also changes your view of the business in total. The growth rate isn't as high as you thought because you were looking at kind of what was prepared maybe in a sim or looking at just the QuickBook numbers. So your view on the growth rate has changed, and maybe how does that affect your view of the business? It also kind of changes the way that you're thinking about, okay, how hard is this thing going to be to get to a level that is really satisfactory for myself and my business partner to feel like we're going to be able to have a good return on this thing. Quality of earnings ended up falling below our threshold in terms of the minimum EBITDA that we were talking about. So while we loved the business and while we were still confident that we could run and execute the plan that we had developed in our early diligence period, we had to have kind of a hard conversation between my business partner and myself to say, is this an opportunity that is big enough for us to pursue? Because unlike a private equity company, search funders are going to be buying one business. And so you kind of have to have one really good shot on goal. It's unlikely that you're going to be able to go in with a plan and say, well, we'll run this one and then we'll buy a bunch of other ones and we'll stick them together and it's going to be big enough size. That's a completely different idea. Our plan was, let's find one great business that we love and that we can grow to a big enough size that we'll be happy. So all of that kind of came out from just the fact that the QV came out a little bit lower than kind of we were anticipating.
Speak to how important that communication with investors and the seller was throughout that process as those findings came up during the QV.
It's kind of a balancing act with both investors and with consumers of the QV. You don't want to be giving kind of the blow-by-blow breakdown because things change really quickly in the quality of earnings. You kind of want to preface it a little bit with the investor set as you're going through. Say, hey, it's starting to change a little bit. It's almost never going to be changing so that the number is higher. You're front-running some of that with your investors. You're getting, I think, a comprehensive understanding from your accountants around why that is the case. Comparing it versus kind of what your model and what your initial data set had said, like, okay, if expenses are up, which accounts, why is that? Is that something we're concerned about? How does that change our view of the business? Having a really good conversation, I think, with the accounting firm to understand, okay, in plain English, what does this mean? How does this kind of affect how you guys would feel about the business. How do we as the buyers feel about the fact that revenue is changed? Does that affect what we're going to tell our investors? In our case, I think we tried to thread the needle there a little bit, and ultimately it ended up working out.
I thought you threaded the needle well, Bob. And, one of the good things about Bob and Tyrell's search for me, selfishly, is that they were based in Austin. And we were able to have a lot of these conversations live in front of a whiteboard and to talk through kind of the changing dynamics and the fluid conversations that resulted from the Q of E. And, I think the way that Bob described the process, he used some terminology and used the word change often, right? And I think it's an important point to underscore that just because the Q of E comes back at less than you expected, it doesn't mean that the deal is off. It changes your approach to analyzing the attractiveness of that deal, but it doesn't mean that you have to walk away. And the North Star for the majority of your investors is going to be assuming that EBITDA is lower than we anticipated and assuming that we still believe off of that lower revenue and EBITDA base that there's no change to our growth expectations. What does that imply for returns? Can we still earn the same return that we believed we could prior to going into Q of E and based on management's assessment and estimation of what their financial profile looked like? More often than not, it dramatically changes that perspective, which then forces the conversation of how do we amend the deal structure? How do we amend the valuation to get back into a zone where this is attractive? This was a little bit unique from a size perspective in that it dropped below kind of the target threshold for EBITDA for Bob and Tyrell as well. And so, there's a fundamental question of like, what do you guys want to do, right? Your investor group can probably still do the deal. And we get to do a multitude of deals. Funding a small deal is not ideal, but it's fine. For the two of you, it fundamentally changed kind of the potential financial return profile and how do we work through that element of this as well. And so it's a very dynamic and fluid conversation. It's an iterative process to get to the right answer and requires some tough follow-up conversations with the sellers as you unearth some of those financial realities.
Bob, moving forward in the story, in an earlier call, you said that eventually the seller was able to cross the emotional Rubicon. That was your term. So how did that happen? What do you think was key to sort of gaining that shared understanding of what was required going forward?
Yeah, absolutely. I think key to understanding where the seller is on that emotional journey is also understanding the fact that for every dollar that EBITDA changes, there's a multiple associated with that. So you go in an LOI and say the deal is worth $10 million and EBITDA comes back lower, it's going to be lower times 5 or 6, whatever the multiple was when you're going in. So they're quickly seeing the ground kind of shifting under their feet a little bit. We try to put ourselves in the seller's shoes. We tried to understand, okay, how will they take this news? They're never going to be happy. You're not going to say, hey, congratulations, we're paying you X million dollars less for your baby. So I think relying on that reservoir of goodwill that we had built up, I think was essential. We had discussions with the broker and the counsel, relating back to what Ryan and Clay were talking about, understanding that the people that were in the corner were really good and they had been through a process like this before. And so they were incentivized to keep the deal on the right track here. I think when the number comes out lower, what our view was, look, this is your data. This is your company. These are the financials. We're going to pay for the quality of earnings one way or another. We don't want to withhold anything from you guys. So let's go through the numbers, show what's happening to, in our case, the student count, what's happening to kind of the monthly starts, which is kind of how they recognize revenue. What's happening to expenses? This was the fall of 2022. Gas prices were extremely high. And it's a relatively small part of the cost structure, but diesel prices had doubled. And so that was something where the business was spending like an additional $15,000 to $20,000 a month. And because of the accounting process that they had in place, I think the seller had a really good idea of that specific line item. So I think being able to show them some of the detail and them understanding, well, okay, that actually does track with what I'm seeing, having run this business on a day-to-day basis, help them at least understand the process was fair. They might not like the outcome of it, but it's kind of like arguing with maybe like the weather or something like that. It just kind of, it is what it is. And so we get to figure out kind of what the plan is to kind of get through it.
Ryan and Clay advising so many lower middle market deals involving one, sometimes two parties that have never done a deal like this before. How often is there that moment where the valuation changes? What do you recommend for getting through that?
It's certainly not uncommon in the space. I mean, when you're thinking about growing companies that have a business such as Bob's, oftentimes that cash to accrual conversion is going to result in a downturn in revenue and EBITDA as you build up that balance sheet. It's those difficult conversations and leaning on your QOV provider to help with that education piece, helping the sellers understand what that process entailed, that we're using their information, their data, really having a level playing field, and just saying, once we drop this data and information in and convert to an accrual basis for these reasons, here's why EBITDA and revenue may be lower than you had expected, but it oftentimes can help the sellers get over that hump.
When you are talking to people who have not gone through this process before, what's a good way to summarize the amount of work required of them and the timeline that they should expect?
Yeah, it's a great question. And I'll speak, certainly financial and tax diligence request list. There's a multitude of other requests, and I think staging those appropriately within your timeline is a must if you're not going to overwhelm the seller, who also has a number of other responsibilities, as we've alluded to. So when we think about a typical 90-day LOI timeline, that initial data gathering for financial and tax oftentimes takes somewhere around 2 weeks. So it's critical that that first week of exclusivity, you engage with your quality of earnings provider, have that kickoff call so we can educate them on why we're asking for these specific things. Ideally, we're getting the QuickBooks file, but then over that 2-week period, while Bob and the investors are doing their commercial or business due diligence, we can monitor the data room to make sure that when we hit that go, no-go mark from the searcher and the investors, we can hit the ground running hard and ideally try to kill the deal in that first week of our due diligence. And those procedures can be fluid. So I know there are firms out there that do a phased approach. We had done a phased approach a number of years ago and found out that it was a more painful, longer process for all parties because things change between phases all the time once we get under the hood and start looking at things. So ideally, we're killing it in that first week, and that takes a number of deals of experience, utilizing our team, collaborating with Bob on what are those things that you're hearing that you discovered that we need to now focus on, which ideally is a 3 to 5 week process from the time that we start to the time that we finish our work product.
We want to kill that deal as quickly as possible if there is a deal killer out there. That's why it's so important to make sure that seller is providing that initial request list before we formally kick off. Because what we don't want to run into is we formally kick off on a Monday and we know revenue is the highest risk area. We don't get contracts until a week and a half into diligence. There's something there that ends up materially changing the numbers. And we've just spent more time and money on that process than we needed to. Bob, I'm curious how you handled is seller fatigue. We know we're only one of the diligence streams, but there's a lot of requests coming their way from Bob and the investors, us, and other diligence streams. And Bob, I'm just curious, how did you handle that seller fatigue as QOV went on?
In those first couple of weeks, any searcher, unless you have a background in the type of business that you're looking to buy, is going to be asking a lot of really stupid questions, and they're going to be asking for a lot of data that the seller probably doesn't have. They're going to be trying to get comfortable with the business the buyer is around. Do I like the industry? Do I like the seller? Do I think they're trustworthy? All these things that are kind of table stakes for buying a business before you get to the financials. You've already, in a little ways, kind of worn out your welcome, maybe a little bit with the seller. And the high of signing an LOI with a big dollar figure on it has probably faded a little bit at this point. And then you bring in an outside party and they have the fears that we kind of alluded to earlier, and they're asking for a lot of information. So I think it's really important in terms of managing it as a searcher to, understand and kind of cadence the asks in an appropriate way. Make sure that the data you're requesting for things that are other than financials, that it's really important and I think imperative to the deal. Things that, to your point, that would kill a deal early on. If there are key contracts or other things associated with revenue that you can get before you get to the QV phase, just understand what those look like. If it's something where they've got a key customer that makes up a significant percentage of the revenue, and the contract says it can't be assigned and can't be taken over if the business is sold, probably something you want to have a discussion with before you start paying for accountants. You don't need an accountant, I think, to tell you that. I think where you guys earn your keep is looking at the whole business in total. And so that's going to involve asking for a lot of data. And you got to know that, before you get into that process, so you don't wear out your welcome going into that. I think coming out of the diligence, after buying TransTech, we will look at the diligence request list that sometimes you get from people who've been through other processes. And there's a lot of things that's not applicable. Maybe their insurance policies for a handful of their employees, when that stuff is not important to, I think, understanding the business early on. Those are things that you should probably get eventually, but you don't want to be taking from that goodwill reservoir before you get to the part that's going to be the most challenging, which is typically going to be the quality of earnings.
Bobby, you've touched on that, but based on what you discovered and learned during the due diligence quality of earnings phase of your acquisition of TransTech, how did you change or modify your plan for value creation based on this new intelligence?
Great question. So I think quality of earnings and the result coming out of that was a huge part of our change on how we were going to run TransTech. Once you actually get the honest truth on what the financials look like, we were able to use the analysis to understand kind of what does the gross margin look like? What does fixed versus variable expenses look like? That really, I think, helped us understand, okay, hey, this is not necessarily going to be just something where it's going to be steady kind of compounding growth. Hey, actually, there's a lot of incentive for us to really invest heavily in growth and in sales. This is a business that was, according to the Q of E, it was growing at, say, 25 or 30% top line over the last couple of years. It was lower than we expected, but it was still a really healthy business. But it was one that didn't have a great sales function built out. And so coming out of the Q of E, we understood, okay, if we invest in sales and marketing and we flesh out that muscle in the business, here is the incremental gross margin that we earn for every customer that we bring on. And through our initial commercial diligence, we were able to say, okay, this is a huge addressable market in North Carolina and nationally. It's a fragmented market too. So if we can be better on the sales side of things, if we can really invest in that, knowing that kind of what the customer acquisition cost to LTV would be, that is something that we as entrepreneurs can understand in the first 90 days what are going to be our highest priority items. We had already assessed that the operations were great. If they weren't, we probably wouldn't have bought the business. We saw that there's a lot of opportunity to continue this growth path and actually invert it even steeper through the quality of earnings. And I don't think that's something that the seller would have known because they didn't have, I think, the right detail, or they weren't looking at it the same way. I think with the Q of E, we were able to say, okay, now that we understand what it actually costs to serve a student when they're coming through, this is a really great business. There's great margins on the business. It's something where we think that we can execute on a plan really well.
And it kind of goes back to that, what are some underappreciated pieces of the quality of earnings process, and that it's not just a check the box exercise. There's key findings that can come out of that, whether that's customer level, product level metrics that are gonna significantly influence your thesis that may be changing and your approach to things in that first 1 to 3 years post close, and what you may change. There's product level margins, potential overspend with certain vendors or in certain areas that you could push that spend elsewhere, such as marketing, to really create a lot more value. Those are all things that we think oftentimes come out of that quality of earnings that readers are surprised to learn once they get that narrative report in hand.
The quality of earnings is obviously a super important part of any deal for investors, for the banks, but really for the searcher. I think this is the company that you're going to buy, and you might have seen it represented on a sim. You might have heard from the seller and their customers and some of their partners about how well the business is doing. But until you get that quality of earnings, you don't really have a validated third-party opinion on it. And I think it's something that you should really look forward to. I know that when we went into the process, it's something maybe a little bit scary because you don't want to uncover something that kills your deal, because you've kind of said, hey, this is a company I really want to buy. I really like the industry. But I think we really relish the opportunity to understand what the actual truth is out there. It gives you a lot of really, really valuable data that It helps you not only understand, is this a company that I want to buy, but it's still something that informs our operating plan afterwards. And it all kind of stems back to that first initial look that we got at the company.
Don't be afraid to reach out to your prospective QOV provider to have some of those questions to ask during your business diligence. And maybe you're going to ask some questions pre-LOI that allow you to move on from that deal before wasting any more of your time. So don't be afraid to communicate and collaborate with your trusted advisor, even before you get it under LOI.
Excellent. Well, Bob Boniface from TransTech, Clay Brownlee and Ryan Turbes, both of Boulay, and Anthony Walker from Next Coast Legacy. Thank you so much for sharing your expertise with Search Party, and I hope I can have all of you back on a future episode. Search Party is sponsored by Avid Bank, Boulay, Mayer Brown, and Plexus Capital. The lead sponsor is Next Coast Legacy.